Okay, we're going to get started. Let's look at our earnings calendar. This is the middle of July. Um, we had the earnings season start this week with JP Morgan and some of the Wells Fargo, some of the bigger banks starting off earnings season. And that gave us a little hint of how the consumer is doing. And they did okay, but a lot of the banks sold off, like Wells Fargo didn't do so good. We have in the coming week, we have Bank of America and Netflix, two of the bigger ones. Um, and then the following week, next week, we're going to have a lot of the big tech stocks coming out with their earnings. And a lot of times that's what helps gain momentum in the stock market, having great earnings. So let's see what happens. This week. I'm expecting a little bit of consolidation still because we're overbought. So let's look at some of our talking points for this week. We have the S&P up. It's gaining momentum. We have 68% of the S&P above the 50-day moving average. It was 40% last week. And we have 72% of the S&P above the 200-day moving average. And that is definitely a sign of momentum. And we're continuing to focus this year on healthcare, telecom, financials, energy, and utilities, which underperformed last year. Our themes for this year are AI and weight loss drugs. And that we said at the beginning of the year, that would be some of the better performing stocks of the year. Now let's look at where we are in the averages for monthly returns. Right now, July is one of the better months, primarily because we have lower volume and people are on vacation, but we have earnings coming out this month. So after the earnings come out, we have no real fundamental catalysts such as earnings in the summertime. We have also a lack of activity with the traders and not a whole lot of news to make the stock market go up or down. We are actually in a presidential cycle this year. So towards November, a good portion of the time, stock market does well in years of an election. A lot of times that's because politicians have to overpromise, and that helps stocks. Now let's look at the S&P 500. We've been overbought since May, basically. We had a correction in May, and you can see our stochastics are overbought, and we just keep levitating. This is called climbing a wall of worry, meaning we're overvalued by about 15% in the stock market, the S&P, but we keep going up. And we've had around 9% earnings growth in the S&P year over year. So that is what's helping the stock market, but we're still a little bit overvalued. So let's keep that in mind and don't get over your skis, because we're going into a part of the year where it tends to go down. Okay, let's look at our inverse correlation of interest rates versus the S&P. We can see this week that interest rates went down and the stock market went up. So this has been one of the best correlations that we have going so far. And same thing with the 2-year Treasury. It's down for the week in a big way, and the S&P is going up. So what happened this week is we had an indication that inflation was getting better, and because of that, there was a better percentage chance of a rate cut in September. So what happened is a lot of the companies that need to borrow money, such as the small cap stocks, they rallied because if the rates they will be charged for borrowing money goes down, they'll grow faster. And a lot of the companies that had to borrow money, that had borrowed a lot of money and need to refinance, they went up too this week. So that was kind of a theme of this week. So let's look at some of the major variables. Um, Oil hasn't done much. It's down around 2%. We have inflation. It was 3.27. Now it's about 3. So it's gone down. So that helped a lot of the market broaden. So there was a little bit more participation by the whole stock market whenever inflation seemed to be a little bit better. The dollar index, it was basically down a little bit, but overall, the dollar index so far this year has been going up. Gold is down 2.5%. It seems like there's a correlation between gold and inflation. So you can see the chart in gold. Let's look at gold right now. You can see there's like a sideways pattern happening. And that's kind of in correlation to inflation. So as inflation has been going up, price of gold has been going up, but right now we're kind of in a sideways pattern with gold. And so maybe as inflation goes down and as the interest rates go down, maybe the gold goes down with it. We don't know. All right, but you see, the dollar has been going up, so that tends to drive gold prices lower. So you have two things against gold right now. One is the dollar is appreciating, and we also have inflation going down. So a lot of people buy gold whenever they're worried about inflation because gold holds its value over time. All right, that was a little good excursion. Now we have the dollar index. Look at that. It's been going up this year since January. And we're going into tech earnings season this week. And we're going to expect a lot of companies like Facebook, Google, Microsoft. They're doing a lot of business overseas, and they're going to say, due to the exchange rate, they didn't make as much money. So we got to be ready for that. But this is a kind of a zero-sum game, as they say, because some quarters um, you get a bonus for dollar going down, and some quarters you get penalized for dollars going up. So you have to like ignore the amount that they lose on currency fluctuations. There's something called constant currency. They grew at 25% constant currency, let's say. So that's a way to really understand how a company's doing, taking in consideration currency. Okay, let's look at our fear and greed index. We're getting more greedy. So last week it was neutral, and this week we're getting into greed. So the greed, take some profits off the table or don't buy. We have a lot of excitement in the stock market right now. And this is probably one of the better months of the year. But my guess is towards the end of this month, beginning of next month, we're going to get more fear. Why we go there, I don't know, but you have to do the opposite sometimes of what the stock market is doing. So whenever people are greedy, you don't buy or you sell. Whenever people are fearful, you start looking to buy things and don't sell. All right. So the amateur investors are bullish. They're still bullish. So the last time they were bearish, it's been a long time, really. Okay, so we don't have it in our chart right now, but probably last October. Let's look at, okay, the VIX is at one of its lowest points of the past, a lot near future. I mean, in the recent past, it's at 12. So people have almost no fear right now. That's a bull market. Um, in our emotional chart, people are starting to get greedier. We're going into earnings season. We might get disappointments. If we get any disappointment from some of the big tech stocks, such as Taiwan Semiconductor saying that they're not generating as much chips, and some earnings, there's some earnings misses, then we're going to start getting some fear into the market. So we're right at that tipping point. People are excited, but we're going into a point of time in the earnings season where anything can happen. And you got to be ready when you own a stock to be in the capitulation mode, despair mode, to be ready for the stock market to go down, because it's in your best interest to hold stocks for the long term. Okay, so let's look at a fact set from Twitter. They said the forward 12-month PE ratio of the S&P is 21.2. That's above the 5-year average of 19, the 10-year average of 17.9. So right now, if we're at a 21.2 PE, that's 9% over the 5-year, but the 10-year is probably more accurate. So 15% above the 10-year average. So when people say on TV, we're going to go down 15%, that's, we're going to crash or whatever it is. Over time, the stock market trades like at an 18 PE, primarily because it's growing, 12 to 13% a year. But if we do have a correction of 15%, then there's a good chance that we'll be back to a 10-year normal. So you got to be ready for any kind of correction like that. All right, so let's look at some of our worst to perform first. Last year, IT, communication services, consumer discretionary did the best. And they're continuing to be the same sectors doing good this year. That's surprising. And health, well, for me, it's not surprising. 90% of my money is in IT communication services because I know they're growing faster than any other sector. But the healthcare, energy, and consumer staples and utilities that did bad last year are starting to perform very well this year. But real estate continues to be one of the worst sectors. Anyway, our themes for this year: AI revolution, any disruption to existing industries, and building out the data centers, demand for electricity, securing the grid and cybersecurity, utilities, such as electric companies increase the demand. So, and weight loss drugs. So these themes affect a lot of industries. And for instance, the AI revolution will displace a lot of jobs. So that'll affect the consumer spending. We have weight loss drugs affecting the demand for junk food and soda. So you have to be very flexible when you're investing and be willing to adapt to new themes and disruption. Okay, so now let's look at the sector performance. We can see that financials are actually one of the better performing sectors. They're reporting this week and next week. We have, let's see, utilities, they're doing well and they're being helped by the AI revolution. That's something we didn't know about at the beginning of the year. And it's becoming, the utility sector has traditionally paid a high dividend, and it's been a very consistent 2 or 3% growing sector. But now they might be returning to some kind of growth. The interesting thing about utilities is they're mostly controlled, price controlled by regulators. So any kind of growth in utilities is companies demanding more of their service because their prices can't be really changed. So let's look at some of the market movers for for today. Okay, we look at the market movers. We see Enphase Energy. They are a company that does solar roof installations. Bank of New York Mellon. So we have a theme of Generac Holdings. Okay, so we have another Enphase and Generac do the same product. Okay, so we have renewable energy. We have AI in Accenture. They offer consulting services, and they're trying to concentrate on AI right now as a major thing they offer. We have banks and and semiconductor. Okay, we have what things are going down the most. We have Wells Fargo. They're a bank that just reported earnings. Um, we have Delta Airlines, Meta, and Citigroup. Okay, so a lot of these banks are reported and they went down. And Meta, I'm not sure exactly why they're down. They're up a lot this year. Let's look at the NASDAQ. What's up the most? We have, mm, okay, well, a lot of these follow within our theme of AI. We have chip ARM Holdings. They do a lot of chips and sometimes AI. There's a lot of companies such as Microsoft and Amazon and Google that are making their own chips and they're using ARM technologies, ARM Holdings technologies. ON Semiconductor, a chip. We have Zscaler. They are antivirus and cyber. So we have cyber, we have, let's see, Micron, which is an AI related memory provider. Global Foundries, they're a chip manufacturer. Okay, so we have a theme of chips today and cyber security, and Zscaler, of course, is a cybersecurity. So that theme that we had at the beginning of the year of AI and data center build out is all in the top 10 of the NASDAQ today. The ones in the lower part of the decliners are there's a lot of profit taking, it's called today. We have Amazon, Broadcom, Meta. These stocks basically have been the best returning so far this year. So there's some profit taking. And a lot of times they do that. People take profits before the earnings come out. Earnings are going to come out for a lot of these stocks in the coming weeks. Okay, that was a good thing to go over. Let's look at some of the sectors that are going up and down. Well, I guess any sector talk should be prefaced by the 10-year. Let's look at the 10-year. You can see that the 10-year has been going down. So in July, it's basically a straight line down. And that's been helped by the reports for lower inflation. So let's look. So we expect sectors that are helped by lower interest rates to be better today. And we expect the sectors, that's basically the hint that we have. Let's look at the sector ETFs. Home construction, of course. People can afford houses better if the interest rates are lower. Home builder, same thing. Consumer discretionary, if people can borrow at lower rates, they can buy things they don't really need. Now we have the semiconductor ETF. Okay, that's our AI theme. And we have telecom ETF, utilities, and materials, technology, and real estate. Okay, real estate goes along with the interest rate theme. Biotechs are up today. And why would biotechs be up? They are a lot of biotechs don't make money. There are a lot of companies, there are a lot of most biotech companies are in development. And if they have a good product, they're usually bought out by a big um, company. So whenever the interest rates went down this week, the whenever the treasury yield or rates went down, the um, the biotechs, the small caps, all were helped by that. So let's look at the ones that did the worst. Gold miners. We thought we just did a little thing on gold, so we talked about that. And oil in gold miners. Okay. Regional banks, ETFs. Um, as interest rates go down, that should help regional banks. The problem regional banks had is interest rates were going up, and they had a lot of customers that had commercial real estate and they needed to refinance their commercial real estate at higher rates. And as the interest rates go down, the regional banks should do better. But let's see. That's what we can get from this. That was a good excursion. Let's go back to our talking points. We're keeping track of Dan Now's best picks of the year. Glad we did this. Amazon is up 28%. Meta is up 41%. Texas Instruments up 20%. XBI is starting to outperform. It's up 10% in the last 2 weeks or so. So XBI, they are the biotech ETF. And we mentioned that it is going to do better as interest rate, the cost of borrowing goes down. So let's see this. Let's keep a watch on this ETF and see if it's actually helped as interest rates go down. And KWEB is one of the worst performers, only up 1.64% this year. Okay, this is a map of earnings that are coming out this week. We have a lot of banks coming out Monday and Tuesday. They are always the first to report in earnings season. Last week we had JP Morgan and we had Wells Fargo on Friday. And this week we're having Bank of America and all of these banks, PNC, Mercantile, we have First Bank, we have Goldman Sachs, which is a bank. So they're going to give us a hint of how the consumer is spending. And that'll help tell us if we're going into a recession or not. We have US Bank Corp. Okay, so all the earnings for the banks will be done by around Wednesday. Then we're going to start the tech earnings season with Netflix. And that'll give us a hint on the consumer, and it tells a lot of times the big tech stocks trade together. So that could give an up or a down for the stock market. That's why there's a lot of companies that are starting to sell off before the earnings, because a lot of traders don't want to hold their positions into earnings season. All right, so here's a article on TMC's second quarter profit seen jumping 30% on surging AI chip demand. Okay, TSMC, Taiwan Semiconductor, we've been going over this for the past couple weeks or so. No, maybe a month or so. And so they're going to be reporting earnings, TMC, right, Thursday. So this article says they're supposed to grow 30% in their profit. So they're basically manufacturing chips for NVIDIA and a lot of the big companies. And so as NVIDIA reports good earnings, there's a very good chance TSMC will be doing good and vice versa. So whenever we have TSMC reporting on Thursday, that'll give us a big hint of how NVIDIA is doing. So NVIDIA is selling everything that they can make, and based on how much the volume that they're doing and they're reporting on Thursday, that could make the stock market go up or down a lot because the whole stock market is kind of riding on the coattails of the big tech stocks. All right, that was a good article. Let's go over Taiwan Semiconductor again. I looked at their earnings estimates for the next couple years on E-Trade, and I saw that they're expected to grow around 20%. That article said 30%, but looks like 20% to me. So the PE is 30, and they're growing at 20%. So the PEG ratio is 1.5. So it's around 1.5 times overvalued. So the good things about them, they're a leading AI chip manufacturer, and that is in vogue right now. They're expanding capacity in America. They're actually building factories with free money from the U.S. government, and that's the CHIP Act that provided that. So that's a headwind. One of the tailwinds, one of the bad things is they might be taken over by China, and then you lose everything if you're an investor. Okay, so let's look at some of the TSM statistics. Their market cap is almost $1 trillion. This is one of the largest companies in the world. Their forward PE is 30, and Yahoo Finance says their PEG ratio is 1.7. That's pretty close to our math of 1.5. The profit margin is 3 times what we're asking, and the return on equity is 2 times what we need for a minimum. So that is really good. So they're pretty well. They're growing very consistently. You can see this very consistent growth. You don't see any negative quarters. But the problem is they're just overvalued right now a little bit. So we'll see if they grow into their earnings this Thursday or not, and we'll keep track of this stock. It looks like a pretty good one. Here's some charts that I found interesting. We have MasterCard, which is right at its 200-day moving average. You can see this purple line here is the 200-day moving average. And we're right in earnings season where a lot of the financials report their earnings. And MasterCard and Visa almost have identical charts. So look at Visa, you can see it's kind of hugging that 200-day moving average, which is right here. You can see that moving average, and you can see it's at the bottom of its channel. So it's growing, both MasterCard and Visa are growing around 20% a year. And right now they have a 70% of the credit card market. But there's a lot of government action that could stop that monopoly, but we'll see. Tesla, here's a chart from Tesla. You can see there was a downtrend. We've been following this since last year, this downtrend. You can see it went up on a good quarter news for their earnings, but you can see that there's a trading range, and it's pretty much in a sideways pattern right now. Their earnings aren't that great. They weren't great enough to go up this much. So they're overvalued. They're not growing as they used to, and it looks like a trading stock right now. It's a very volatile, and it looks like it's stuck in a trading range. But their earnings are coming up. No, their earnings. Let's see when their earnings are. No, not yet. Tesla's earnings are coming up on July 23rd. They reported an amount of deliveries 2 weeks ago or so, and that made the stock go up. But this earnings could make the stock go back down into this trading range we followed here. So we'll follow that stock because it's an interesting one. But right now their growth has pretty much stalled. They're not growing like they used to. Let's look at Eli Lilly. They're at the top of their channel, and they're super overbought. They've had a slew of good news come out. They have a new drug that was approved for Alzheimer's, and they have a drug for weight loss and diabetes that's selling like gangbusters. So during the summer months, you can see they're overextended right now and overbought. But during the bad months of the year in summer, you can expect it to go back down here and then maybe go up here by the end of the year. But the reason I'm doing this market timing, it's called, is for new positions. If you have $1,000 to invest in a stock, you want to buy it when people are selling, not when people are excited and buying at the top. You want to buy it whenever you see the stochastics really low, see below 20, like right here, and it's near the bottom of its channel. And here's another time when we had an oversold condition at the bottom of its channel, oversold condition at the bottom, it's oversold. Right now it's overbought and it's super overextended right now. So Eli Lilly is growing around 30% a year, but it's very expensive right now. So let's look at Costco. We've been following this a while, and it's grown around 10% a year. Their earnings around 10% a year, and they're overbought, but they're starting to go down. They went down a lot in the past couple of days. They announced they're going to increase their membership fees. That was the big news. Costco raises membership fees for the first time in 7 years. I don't know if you're regular to this meeting or not, but we've been talking about this for a couple of years, the possibility of them raising their membership fees. And that is a catalyst for the stock going up. But we're amateur investors. If we knew that they were going to raise their membership fees, everyone else on Wall Street did too. So what happened this week is as soon as they announced that, the stock sold off. Usually you'd think that would be good news, but that's called buying the rumor and sell on the news. So that's exactly what happened. So the whole stock market was expecting that, and I'd say a good 90% maybe of their profit comes from membership fees. So we're going to keep an eye on this and see if it corrects anymore because it's overextended right now. Let's look at their earnings estimates. So I looked at their earnings estimates from E-Trade, and it seems like they're growing around 13% a year. This 8%, they basically raised their membership fees by 8%. That will help their bottom line by 8%, basically. I would think that would help their stock by 8%, but it didn't. It was just sell on the news. So their fair value is around 227 because their forward PE is 48, which is really high for a retailer. They're only growing at 13%. So they're almost 4 times overvalued. So if you divide the current stock price, 842, by 3.7, you get the fair value of the stock, which is around 227. But they say that you pay more for a car that starts. So if you see a stock and it's consistent growth, you don't have negative earnings, it's a very consistent 13% growth, and there's nothing really stopping it, then you pay more for it. So in this case, you pay 3.7 times what it's worth because it has very consistent earnings. This is the kind of stock that I would look at only when there's a huge sell-off in the stock market, like maybe the time we had COVID sell-off, and maybe then the PEG ratio go closer to 2 or 1. Okay, so the headwinds are increasing membership every 5 years or so. Price of gas remains high. So a lot of people keep their membership only because they have cheap gas, or maybe that might be a major benefit. They have a loyal customer base, maybe over 90% retention of their customers, and very steady growth. So those are the good things. It's too expensive for me, and it's not growing fast enough. I like something that's a lower PEG ratio, maybe 2 or 1, that's growing, maybe that has more potential. There's no real they have some competition with Amazon and Walmart, and so it's not like a monopoly. So that's another reason why I wouldn't be jumping in and buying it right now. Okay, so that is, let's look at some more what's going on in the stock market. Okay. All right. Well, I think that's what I have to say for today. All right. Well, thanks for attending. I hope you have a good week coming up. And if you have any questions, let me know and I'll try to answer them. All right. See you next time.